morning and welcome to the FirstRand Namibia annual results broadcast for the financial year ending June 2021. I'm Tracy Eagles and it's my pleasure to host you for this morning's discussion.
FirstRand Namibia has announced its annual results for 2021. Here's an overview of the group's performance. Total deposits were 36 billion Namibian dollars, down from 38 billion Namibian dollars in the previous year, while total advances stayed steady at 30 billion Namibian dollars. The ordinary dividend declared for the end of 2021 is 118 cents per share, combined with the interim dividend of 94 cents, totaling 212 cents per share, compared to the total dividend of 154 cents in 2020. Assets under management grew from 14 billion Namibian dollars in 2020 to 15 billion Namibian dollars. Tier 1 capital was recorded at 17.7% compared to 15.9% in 2020. Customer satisfaction scores came in higher than in 2020, speaking to increased appreciation for the use of easy digital and alternative channels countrywide, allowing customers to bank better and save more. In terms of digital innovations, FirstRand Namibia remains the market leader, showing strong growth in headline earnings at 1,023 million, compared to 867 million Namibian dollars in 2020.
The operating environment calls for solutions to the end-to-end needs of our clients. A mindset of optimism enables solutions for the many hard realities we need to address towards a more globally competitive Namibia. Our integrated results announcement today reflects forward-looking investment potential in early green shoots funding, leaner application of our resources to enhance customer experiences, as well as steady internal investment in our talent and fit-for-purpose transact, lend, insure and invest customer offerings. The plan in our financial resource management was always to emerge strong with a sound capital base to support growth. This position, coupled with our diversified portfolio, allows FirstRand Namibia to deliver more than geared exposure to the macros to our shareholders. The impact of the pandemic on the Namibian economy will be with us for some time to come. Through our banking franchises, F&B and RMB, we extended meaningful support to protect the national commercial base and capacity of the country, and also facilitating much needed domestic and foreign investment. We are very clear about our role in the economy and in the daily lives of our clients and the societies in which we operate. We remain very excited about Namibia's potential as we collectively steer to the other side of the pandemic and to rebuild Namibia's economy. Thank you.
With me in studio, Conrad Dempsey, CEO of FirstRand Namibia,
Good morning.
and Oscar Kapalau, Chief Financial Officer of the Namibian Group. Welcome, gentlemen. Today we have analysts and investors with us. Thank you for being part of our broadcast. To all of you out there, please feel free to use the chat box on the screen, post comments and questions, and we'll pick up on those in the live Q&A right after this. But before we do that, Conrad, thanks for the handy summation on that video. I really enjoyed it. I think it's always nice to start off that way, just a little bit of a hint of this and that. So maybe some more details on the areas that we should focus on when Oscar does the presentation.
Yeah, good morning. Thank you, Tracy. I think Oscar's got a very interesting deck of slides for us this morning. And I think there's three areas to have a look at as we go through it. In the earlier clip, I referenced the importance of global competitiveness of the Namibian economy and the importance to have strong businesses and strong commercial capacity in the country as we go forward. And I think if you look at the numbers that Oscar is going to show us today, you'll see that FirstRand's very well positioned to be a strong player in helping to rebuild the economy on the other side of the pandemic. The balance sheet's very well provided for future shocks. We've got a very strong capital position at the moment. It's an area of big discipline in the organization that we spent a lot of time thinking about. Our returns are tracking very well on the capital that we deploy on behalf of our shareholders. I think the cost containment is showing a very good trend over time, and particularly proud that we're able to maintain that cost containment without retrenching any staff. And I think also if you look at these numbers, an organization like FirstRand can only be successful if across all our franchises, our clients are successful. And whether it's in F&B or Ashburton, R&B, Outsurance, any of the businesses that we have across the portfolio, where our clients do well, we do well. And an area where we've really provided a bit of support this year for clients to manage these situations is particularly in small business, where you would have seen over the year we've released a small business toolkit, spent a lot of time training, assistance financially and in terms of business capacity for small businesses, working with government agencies around business support. And we really see that value coming through as these businesses are able to continue to trade and continue to keep people in employment. By no means easy, but these businesses, I think, are important on the other side of the economy as we need to get to recovery. And I think then also when you look at the numbers this morning that Oscar is going to present, one thing that's starting to come through nicely in FirstRand is the value of a well-diversified portfolio with strong participation in core parts of financial services in the country. Our asset management business is growing quite nicely. Our core niche products within retail banking has had a great year. Our investment banking business continues to be a resilient growth area for the business. And I think as we look forward, we're quite excited about what we can do in markets and some of our other places. And also insurance really showing quite good opportunity. So Tracy, with that, we get to a position where the business no longer just tracks the macro performance of the economy. And I think as we go forward from this year onwards, it's important for us and for our investors that investment in FirstRand is not just a geared exposure on the economy. It's an opportunity to de-link and have meaningful growth even in tough times.
Thank you, Conrad. Just to comment on that, I think you're right. The investor outlook has become a whole lot more holistic. And diversified portfolios, opportunities in terms of the way you do business, the right way of doing business, ESG. These are the things that are actually setting the new trends and are important for making sure that we don't just present the one bottom line. But in terms of bottom line, over to you, Oscar. Some opening thoughts around what the results look like, and then, of course, take us through the pack.
I agree with Conrad on the diversity of the portfolio and the benefit thereof that we saw during June 21 financial year. There are several positive trends already that we are seeing. The balance sheet is strong, well capitalized. Our credit loss ratio already much better than what we thought of a year ago. Our ROE already shows. But the trends are all positive at this stage. Compared to where the world was a year ago, we're definitely in a better space now.
Let's have a look at the full pack.
Before I dive into the details of the pack, let me just stand back a few minutes on the macros, knowing that we have investors from offshore also on the call. In terms of macros, yes, Namibia was also impacted by the pandemic. Of importance to note in our world was a 300 basis points cut in the repo rate late last year. We're also looking at inflation that's up to 4.1% from 2% a year ago. And the other one that's of interest at this stage would be credit extension, was in the single digit and it closed the year at 2.7. Now, just touching on those three, I mean, the other one, of course, of importance would be the GDP contraction last year, which was 8.5% down. Quarter one released recently down 6.5%. That gives you the backdrop of the environment we were operating under. And with that, then let's get to our numbers. So on the screen now we have our scorecard. I'll start off there for those who go straight to the summary. Starting off, our ROE up to 19.4%. The other number I want to highlight already from the word go is our credit loss ratio at 0.8%, much better than what we saw last year at 1.8%. The other number in terms of efficiencies, looking at the OPEX over total assets, flat at 4.83, slightly down, but that's more a factor of the NII that's down and not pressure on OPEX at this stage. And then just as to what was the impact on our business, you can see that the pre-provision operating profit, a decline of 2.2%. And then our balance sheet, relatively flat, but in the following slides, I will then unpack the material variances from a year-on-year performance. Now, if we jump straight into the income statement, given again the macro backdrop that I just spoke of, you'll see most of our numbers year-on-year show a decline. I mean, from the top line, you can see the net interest income is down 7%. You can see the impairments, a lower charge than what we saw a year ago, down by 57%. Non-interest income slightly up. And then also a good number to report on is our OPEX, that's down 2%. And that's how we get to a bottom line growth of 23%. And then in the following slide, we'll speak of the pre-provisions again. And then from a headline earnings perspective, I mean, that's up 19%. And already early on, again, it's the sum of the parts. There was no single silver bullet that contributed to the bottom line ending up 18%, but it's good work done across all lines through our income statement. Again, lower provisions compared to the prior year. And how did we manage OPEX early on? I mean, REM makes up 58% of costs, and early on, REMCO made a call in terms of managing our OPEX through the pandemic that contributed to the minus 2.1% we see on the OPEX line. And then from looking at the FirstRand earnings perspective, our banking activities contribute 95% of our earnings. Now, when we are referring to pre-provisions, again, provisions do carry some judgmental elements to it. So in terms of how did the pandemic impact our business, that's what we are referring to pre-provisions operating profit. There's the minus 2.2, again, starting from the top. As you can see, the interest income being down 6.8%, 1% up on NIR, OPEX down 2, and that's how we get to the 2.2. And then highlighting the impairments separately, again saying you can see what the macros impact were on the business. We also felt the pandemic. That's how our earnings, we contained the decline to 2.2. And then from an impairments perspective that we, at this stage, saw already the book behaving much better than what we anticipated a year ago. And with that variable, we see then the bottom line up 23%. And then in the next slide, again, this more for those who love more art than numbers. Again, just speaking of our headline earnings in terms of how did we get to the 1 billion number there. It's again, we speak of lower interest environment, impacts our NII down 6.8, lower impairments charges, both specific and portfolio. And then managing our costs well results in a better bottom line in terms of headline earnings year on year. Jumping straight to net interest income, again, low interest environment across the world and also in Namibia. Overall down 7%, and that speaks of the repo rate cut that was down to 300 points. Again, in the current year, we had the full 12 months impact of the rate cut, whereas last year it was only for a quarter. What we've been able to do, of course, is, I mean, last year we spoke of the 7-point plan that we had in-house as the pandemic started. I mean, in terms of pricing discipline, that's always on the table. Given the rate cut, our interest income was down 21%, but good work went into managing our interest expense. You can see that's down by 37%, and the combination of that gives us our decrease of 7%. And then from a margin perspective, that's the next question that we often get. Through this cycle, I mean, we did lose 40 basis points, but given negative endowment in a low interest environment, it's still a pleasing number to see that we only lost 40 basis points through the cycle. And then it also speaks to the single-digit growth that we saw on our balance sheet. But being down 7%, given the 300 points, was still a good outcome from an interest income perspective. Impairments then, you'll see that we managed to retain the overlays we raised last year. And given the macros, we are comfortable with our level of provisions. If we look back a year ago, our portfolio provisions stood at 633 million. We managed to raise it slightly to 692, which brings our coverage ratio to 2.3%. And just to also show you where we are compared to, let's say, the last crises we saw this side of the world, our portfolio provision in June 2008 was at 146 billion, pushed up to 152, and today we are speaking of a portfolio provision of 692 compared to a year ago of only 633 million. I mean, additional factors that we had to take into account when concluding the portfolio provision was the impact of the third wave that hit us just as we were closing off the financial year, the level of vaccination in the country, and probable lockdowns that are still coming our way within the next 12 months. But at this juncture, we are able to say that we are comfortable with the level of provisioning we are carrying at year end. So in terms of our provisions, from an income statement perspective, the charge was lower than a year ago. And you need to put yourself in the shoes of a banker a year ago. A year ago, June 20, we had 3 months experience of the pandemic, whereas now we are at 18 months level of experience. We've had the benefit of seeing how the book behaves during this period. So you'll see there in terms of stage 1, stage 2, that's the number that's significantly down from a charge perspective from a year ago. And IFRS 9 was always intended to be a forward-looking accounting standard. And then also from a provisioning perspective, we are looking at our house view. And what we're taking into a house view is our view on GDP, our view on inflation, and then also on the repo rate. And further on, I mean, in terms of it's not only one set of numbers. I mean, we have a core view. We look at upside, should the economy perform better than what we expect in the core view. But on the other hand, we're also looking what if GDP plays out and all the other variables poorer than what we have in core. And of course, given the impact of the third wave and potential fourth wave, we had to consider a stress scenario. Taking all that into account, that's then the number that we ended up with, that we didn't need the same level of judgmental post-model adjustment as we did a year ago, where we took an additional 252 million. That's why the charge for the current year is much lower than a year ago, but at the same time, we were able to retain the overlays that we raised a year ago. And given this, then it was a significant contribution to our bottom line. But at the end of the day, it's taking into account our view of the economy going forward and then the behavior of the book during the past 12 months. The other view then still on provisions. Yes, our NPLs did move up to 5.2% from 4.4%. Again, as I mentioned in the previous slide, I mean, the forward-looking indicators do impact our level of provisioning, but we were able to maintain our coverage ratio and in fact slightly improve. So yes, the book did deteriorate, but that was to be expected, but at least our coverage ratio still holds as good as we had it last year at the beginning of the pandemic. Moving on then to our non-interest revenue. Overall, growth of 2.6% to 2 billion. And on the slide there we're showing what happened in the bank and then the non-banking component. But pleasing again at this stage is to say we did see volumes grow across our channel. So once again, the resilience of the business was tested, and it does reflect in our numbers that overall our volumes are up 8.5%. The lockdowns definitely did impact our business. Again, to take you back at the start of the financial year, Commerce was in a lockdown, Erongo was in a lockdown, so that did constrain the volumes then. But we had the best December ever. As soon as the lockdown was lifted, we saw those volumes come through in December. And again, unfortunately, with the third wave, we lost volumes again in the last 2 weeks of June. But at this point, just highlighting again, yes, the lockdowns do impact our volumes, but overall, we still saw volumes across our channels picking up. In the second half, there were regulatory changes that had been in the pipeline for a while. It cost us 57 million of revenue. From a global market space, we had lower revenue in the current year, but overall fee and commission income in the bank was up 2%. Quickly touching on insurance, mixed results there. On the short-term side, business was down 26%, but our JV then on the long-term insurance side made up for it, that we are only down 4%. Again, the diversity coming through. Short-term down, but long-term insurance came through for us, that the decline was only 4%. I mean, the digital versus brick and mortar migration definitely played out still during the current financial year. I cannot speak of volumes without tapping into our various channels. I mean, the star at this stage is the banking app. You can see they're up 107% year on year. The branch remains relevant. Volumes were down 6.5%, but you can see the migration there. More people swiping, speed points are up. E-wallet, a brand on itself, still up. Cash, on the other hand, I mean, ATMs activities, overall down, but we've seen the migration of deposit out of the branch into the usage of ATMs. Cell phone banking also up, but you can clearly see as to the benefit of the digital platform definitely played out during the current financial year, during the pandemic. And again, as to, yes, there's still space for the branch, but our digital channels continue to pick up more and more volumes. And I mean, an e-wallet, of course, speaks to financial inclusion. It's an amazing tool that just takes banking further than what we initially thought it would be able to. So from a volumes perspective, overall, yes, given the macros, our volume still came through. And again, digital winning this race in terms of picking up volumes that were lost in the branches for various reasons. I mean, as we go into lockdown and branches lost volumes. And continuing then on the theme of volumes, following the behavior of clients, it's given us an opportunity to modernize our branches. We've built more capacity in the call center to pick up volumes again as people are calling from home or wherever they find themselves. We continue to roll out ADTs. We've moved, example, the Windhoek branch from leased premises to owned premises. And you'll see there a couple of branches we're able to convert to self-service branches, again, still on the theme of catching up with customer behavior. And then there are those branches that we closed given the level of activity or the proximity to other branches that could pick up those volumes. And the end result of this with the branch transformation, I mean, we do then achieve savings out of this exercise, that we are saving on square meters, lower leases as they come up for renewal, and then the related costs that come from premises and infrastructure. But it's again as to the pandemic was not the start of this journey. Branch transformation has been on the cards for a while, and this was just another year in terms of, but it still gives us that opportunity to refresh our branch network. But in terms of customer behavior, as you'd seen in the previous slides, clients are comfortably transacting on the app or cell phone banking and e-wallet and not necessarily needing the branch every day as they used to before. And that takes me to our OPEX, moderately down, 2.2%. From a cost to income ratio, slight deterioration, but again, just highlighting that it's more a factor of our interest income decreasing by more than the decrease we saw in our OPEX. And given from a staff cost perspective, staff costs making up 58% of our cost base. I mean, early on in the year, I mean, again, based on our REM cycle, to already contain the costs at the beginning of the financial year, there were no increases to EXCO, below inflation to managerial staff, and non-managerial got inflationary increases, and then the long-term incentives did not vest, so that credit came through our staff cost line. On the property cost side, refers to the previous slide that I spoke to. I mean, the benefit of work from home, the modernizing of the branches, we are seeing that benefit still play out. The other cost speaks to then the impact of the lockdown. Communication costs went up, and the work from home arrangements also impacted some of our other costs. On the computer cost sides, there were licenses that we managed to retire, renegotiate certain rates with suppliers, but overall, I mean, computer costs remain a significant part of our cost base. Yes, speaking as a CFO, we remain generous during the pandemic. If there's one line we did not cut on, remains our CSR responsibility cost base, that the foundation continues to get its 1% of headline earnings, and on top of that we have the Hope Fund that we also contributed to in the current year. So overall, I mean, cost focus remains top of mind and it stays on the EXCO agenda. Yes, slight deterioration in the CTI, but it's a factor again of the revenue. But as we see our interest rate cycle normalizing, we should see the CTI ratio also normalizing, but cost focus remains definitely top of agenda. Let me move on to the balance sheet. We have a strong balance sheet, total assets of 43 billion, equity of 5.6 billion. NAV is up year on year. If you look at our balance sheet, it's of a typical banking group. When we speak of liabilities, primarily deposits, and on the asset side, advances make up the bulk, followed by investment securities. And the investment securities, that would be the liquid assets that we hold in our various regulated entities, and primarily government paper. And in the following slides, I'll just quickly briefly speak on deposits and advances in terms of year-on-year movements. So overall, credit extension was single digits. End of June clocked in at 2.7%. Looking at our own performance, overall our balance sheet was flat, but it's again the benefit of the franchises that we sit with. Retail exceptionally well done, a growth of 4%. Commercial was down 6% and RMB down 2%, but overall bringing us to a flat advances group. But it's again looking at the various components of our advances there, and home loans being up 5.3% year on year. Given again the macro's backdrop, it's a good number to be looking at this stage. And as previously mentioned in the impairment slide, we are well provided for in terms of the exposures that we hold. From the deposit side, again, a favorable mix change during the current year, that given the performance of the deposit franchises, again, deposit franchises referring to FNB retail, commercial, and RMB corporate, allowing us to reduce our institutional deposits, which were then down 29%, and the flat number from the deposit franchises. And the point 3 then needs to be seen in context of a year ago, we managed to increase that by 19%. So therefore, we are coming off a high base, which still allowed us to reduce the expensive deposits in the center, and then also then giving us the benefit of a better average cost of funding when you look at the change in the mix of our liabilities, and as you saw in our interest expense line, down by more than what we saw the decrease in our interest income. Again, applause to the team in the deposit franchises for defending the 29 billion in deposits. Moving on to capital management and our dividend. Strong balance sheet, well capitalized for, in terms of the factors that we take into account to get to a dividend decision. It's considering our stress testing that we do on an annual basis, looking at our core equity, again, making sure there are no constraints in terms of our large exposures that we have and the growth in the business in the pipeline, future regulatory accounting changes that are in the pipeline, and also the level of provisions that we have at year end, and also looking forward, and then also looking at our 3-year budgets outlook from a profit perspective and demand on risk-weighted assets, and then also taking into account what our investors expect of us given our earnings. Taking all those factors into account, in our current capital adequacy ratio that was at 20% overall end of June, we declared a final dividend of 118 cents, taking our total ordinary dividend for the year to 212 cents compared to then 154 cents from last year. So it's on the back of being adequately provided for and the factors that I just mentioned there earlier, and given the growth in earnings, we are then in a position to declare a final dividend of 118 cents. In summary, several factors, positive trends that we've seen. Again, concluding, impact of the pandemic, our pre-provisions numbers were down 2.2%, but a good ROE, clocking in at 19.4%. Credit loss ratios of 0.8, much better than what we saw last year. And from an efficiency perspective, we've managed to keep the business as efficient as possible during the current period. Thank you so much.
Thank you, Oscar. So steady returns in an unsteady time, and well done to the teams that pulled this together and brought this to our audience today. That solid set of results, Conrad. Some closing thoughts, particularly around strategy achievements and where to next?
Yeah, thanks, Tracy. And thank you, Oscar. I think it's a really solid set of results that has come through there. And I think really in a great position to be at a time like this, be able to still bring numbers like this to the market when a lot of great effort and work goes together to bring it forward. In terms of strategy, I think our strategy is working. And why am I saying that? I'm not just saying that because of the healthy set of results that the business was able to deliver. And if I look at our customer satisfaction data that's coming through, it's consistently improving. So our customers are telling us their experience is becoming better. The way that they engage with us is more pleasant. We're able to offer more bespoke and niche solutions to our clients. Our pricing strategy seems to be very well received. You know, it's now simpler, more accessible, and cheaper than ever to access financial services than through the traditional, as Oscar called it, bricks and mortar approach that banking used to be, and not just banking, all financial services. And I think the result of that we can now see is a healthy business that generates shared value, and value not just for our shareholders, but value for our clients, value for our staff, value for the communities in which we operate. One of the things that I think is quite exciting if we look forward is we're on a big journey to simplify financial services a lot. We think there's still too much paperwork in the process, and not everything is very intuitive and simple to do. So we've created 2 client clusters, a retail and commercial business and a corporate and institutional business. And within each of those, so let's take it within the retail and commercial business, we think about the end-to-end financial services needs of a retail client. Whether it's investment that they want to make, they want to borrow a bit of money, they want to transact, they need insurance. We now, not from a product perspective, but from a client perspective, have set up our business to really think from the position of a client, and how do we make it easier, how do we make it more accessible, how do we make it simpler, and it's just a bit more fun to engage in financial services. And if I combine all of this and with the cost efficiency that Oscar also spoke about and how the alignment is nicely there, I think our investors can look forward to a growth year. We very optimistic, and I think also if I talk to our clients across the board, sentiment seems to be picking up well, and I firmly believe that sentiment is the strongest catalyst for economic growth. Sentiment is what drives us to make an investment, to expand a business, to hire another person, and that sentiment across the board in Namibia is positive at the moment. And then I think maybe just, Tracy, as a concluding thought, just a big thank you. A big thank you for our frontline staff out there who's managed to ensure that clients get served every day in tough conditions. The frontline staff in healthcare, in all public services. There's a lot of unsung heroes that work behind the scenes this year to really keep things together. And then for every FirstRander in our business, in whatever franchise of our businesses, who comes to work every day and makes sure that we're able to serve clients and we're able to help and we're able to continue to build on this dream of making Namibia globally more competitive in order to be a great place to invest and a great place to come and grow and employ more people.
Thanks, Conrad. I remember when the pandemic first hit, we all wondered what was essential services and would we make the cut? But I guess being a systemic bank and contributed to the economy, that's also part of how the team is pulled together, knowing that they were important to the ongoing flow of business, of lives, and that pulled them out of their homes and into the branches. So we're very grateful for that. Their commitment is definitely what is saluted with results like this. So thanks so much, everyone, for watching this part. Do want you to stay on. Make sure your comments are in the comment box, or if you've sent something through to our mobiles, you all know us. Any other queries in the chat box, put them in there. Stay tuned. We'll be right back. Welcome back. Let's jump right into the questions that we've received today. Thank you for using all available means to send them through. So the first question that we have today in terms of our results is, what is the strategy around non-interest revenue? I'm going to send that one right over to Oscar.
As I touched on earlier in the slides, from a non-interest revenue perspective, again, the growth is coming through the volumes that we see across our channels. And again, the brick-to-mortar digitization conversation continuously ongoing. So in terms of where we see growth coming through, it will be more on our digital channels, but the branches definitely still have a place in terms of our points of presence. But the growth will definitely be more in the digital space, that as our clients continue to go on self-service channels.
Mm-hmm. Thanks, Oscar. So here comes a question that tells us again and again we're a people's bank in many regards. So the question is, in the current scenario, retrenchments have featured across SA banks, specifically over the last 24 months. Is this on the cards for Namibia?
Tracy, thanks. I think You know, if you look at where Namibia is and where unemployment is in the country, obviously the ability to try and retain every job is important. And we've been very fortunate that up till now, through this pandemic, we have not retrenched anyone. We do, on an ongoing basis, optimize the way we look at capital across the business, whether it's physical, human, or financial capital. But we're in a very fortunate position so far that we have, up to date, not yet had to retrench anyone. And in fact, Tracy, as things are today, if you open any of the media, you'll see that we're actively recruiting at the moment. And we're really building our capacity in the areas to better serve clients, to better extend credit, better understand our client base and the economy a bit better. So the nature of roles is changing. That's definitely happening. Can I completely rule out that there will not be retrenchments at some point? I don't think so. The outlook is uncertain. We've got no idea if this fourth wave was the last wave, or are we in for 6 waves, 10 waves? Is the Delta variant the last variant that we have to deal with? And what is the systemic impact on the economy? But our stated intent is definitely that for the moment, we do not wish to engage in retrenchment. And I think we've got 1 or 2 other levers we can still pull before we need to get to that sort of discussion.
Yeah, that's really good. And I think the most important part of that as well is this continuous reskilling and upskilling of the people that we have, and then opportunities to develop our talent framework as we go forward. So looking at how we equip our people, and then also some exciting developments on the horizon around first jobs coming to people.
Yeah.
Really excited about that. So we're looking forward to making more of what we have. One of the things that we've been very proud of for a long time is this is definitely an entrenched Namibian company, with nearly 40% owned by Namibians of our shareholding. Also, our staff is, I think, something like 99% Namibian. We're not going to change that. We're invested for the long term in the people here and in the best results for the country. I have a question that has come in on YouTube. It is management's view or position on the repo rate cycle and on home loans, the local property market. I'm not sure who wants to really take that, but let's talk about the repo rate cycle first, Oscar.
Thank you, Tracy. If I go back to the last MPC statements by the 2 central banks, again, the repo rate decisions are based on data and the risk in the environment. And looking at the language used by the governors, again, we are looking more at rates most likely going up than down in terms of where the cycle is, looking where the inflation forecast is. To December in this calendar year, most likely flat, but definitely when we look at the calendar year 2022, at least 50 to 75 basis points increase should be expected.
All right. Part of that question was around home loans. Some thoughts around affordable housing, the home loan book. I know with affordable housing, it's definitely on our radar.
Yeah.
We've always had those opportunities, but really focusing on them now. But perhaps the book?
Yeah, Tracy, I think it talks to sort of a bigger credit thesis that we think a lot about. Housing is, if you look at our book and you look at the breakdown within our credit extension, it's a big anchor. I think we're probably proportionally the biggest provider of home loans in the market. And we believe it's a very important part of a bank to be able to provide somebody with a respectable and safe home and a place to call home. And that's why also for primary residents, we take a very different view than for investment residents. And that then talks into affordable housing. It's an area that I think across Namibia has gotten different levels of focus over time. We believe there's some very exciting opportunities that's completely resetting the base on what affordable housing means. And if I look at the awesome work that the likes of Development Workshop is doing at the moment, and you align that with slight policy change, you can start to put housing for literally 100, 200,000 within accessible range to people. But yes, the outlook on housing, we think from what we see at the moment, especially in the entry level, it's a robust, active market. It's a market we've got appetite for. There's good trading in that market. In fact, the house price index in that space have started to tick up nicely. Obviously, the luxury end of housing is having a little bit of challenges at the moment, but I think that's purely a factor of discretionary savings that is not as strong as it used to be at 2015-16 levels. And I think, Tracy, just on that point, while we're talking about it, overall, if we sort of think housing and then you start to think credit beyond that, we're really in a space where we have got strong appetite for credit extension. We're bullish about the opportunity set out there. Unfortunately, credit demand at the moment is not very strong. And I understand to a good extent, households are quite indebted, so cautious on taking up more debt. Businesses are protecting their balance sheets. But we do believe that as sentiment changes and the outlook starts to look better, that businesses will start to take up more credit again, to expand, to grow, to replace fleet and capital. So I think the demand side of credit will hopefully pick up in the next year. And by all means, on the supply side, our appetite statements across the board is quite hungry to grow in that space.
Oh, awesome. I know that we have in the retail space, in the commercial space, a lot of space and headspace and thinking around how to make this possible on the individual basis. And then also, the period that we're in, this hopefully soon to be post-pandemic period, this recovery period, allows for people to open up psychologically around where they want to go. And in terms of where we are, we're ready to partner on that. I think it's important that we continue to push for growth wherever we can. If you look in our R&B space, the opportunities around infrastructure development, mining, fishing, these are the areas of expertise that we have in the group. And those relationships are important to us, and they continue to be a feature of the bottom line outcome.
Absolutely.
Definitely in commercial, our emphasis on SME development, and specifically there around in the mid-touch space. Real opportunity to say, we've helped you through the COVID with a number of programs that we put in place, from working capital through to actual personal loans. We're even running something around in terms of helping individuals around medical loans because of the severity of the impact. But in each space, we are ready and willing to partner you. Our thanks go out to the team again, and I'm not getting any further questions. Let me have one more look. I think we're doing fine. So thanks everyone for your engagement in these FirstRand Namibia annual results. Please feel free to make contact with us. You know that you can engage with us at any time. And just as a final thought, building a globally competitive Namibia begins here. Thank you very much, everyone.
Absolutely. Thank you. Thanks for joining us this morning.